CPI Reactions. That's our topic for today's Backstage Pass. Good morning, friends. Stock futures and bonds are both up pretty sharply so far this morning in reaction to CPI data that was released. Mortgage bonds are up 144 basis points at the time of recording. The 10-year yield is down 17 basis points, trading under 4% for the first time here in November. It's coming in at about 3.92%. Yesterday, the national average for a 30-year fixed-rate mortgage, well, that came in at 7.22%, a little uptick, but we do expect to see that drop today, come down a little bit based off of the reaction in the markets. And look, the reaction in the markets, this is in response to better than forecasted CPI data. And we've been talking about CPI for a couple of weeks now, and just this reaction really shows you how important this data report is. Now let's jump right into it. CPI data, this is Consumer Price Index. This is a measure of inflation, basically measuring the prices that consumers pay for goods and services. Month over month, the headline data for the month of October showed that CPI increased by 0.4%, but this was much better than what was expected. Expectations were at 0.6%. The headline data for year over year, well, that decreased 0.5% to 7.7%. The forecast was going to be 8%. It came in at 7.7%. So definitely a great beat, much better than expectations on the headline data. Now, core CPI data, this strips out food and energy prices. Core CPI month over month came in at 0.3%. Again, better than what was expected. What was expected was a 0.5% increase. And the year over year core CPI, well, that dropped by 0.3% to 6.3%. And again, this was better than what was expected. 6.5% was what was expected for the year-over-year core CPI data. So in all of the categories, CPI beat expectations, and beat it not by just a little bit, beat it a couple of percentage points, or tenths of a percentage point. Those are big beats, and the markets are reacting favorably to that. Now, what I do want to say too is that our expectation here is that this is not necessarily a big shift. We're moderating our expectation just a little bit on this because in history, in most recent history, every time there's been big data releases like this, the markets have initially reacted very, very strongly and then moderated their reaction back, whether it's for better or for worse. We expect the same thing to happen today. 144 basis points is a big move up for mortgage bonds. We do expect that to moderate some. So our expectations are this may not be a big shift or the big shift that we're looking for yet, but this definitely is a step in the right direction for inflation. Now, we did get some other news today as well. We got initial jobless claims for last week. That came in at 225,000. That was 7,000 higher than the previous report and 5,000 higher than what was forecast. And the continuing claims increased as well. So, just some on the job side of things, jobless claims are going up a little bit. And if you watch financial market news like CNBC or something like that, there's been a couple of rounds of layoffs that have started to happen at major companies. And, again, that could show a little bit of cracks in what has been a very, very strong jobs market. And all of these things are signs that the economy is slowing, but all to one purpose, trying to get inflation under control. And the CPI data and the jobs data just shows that we're going in the right direction to get inflation under control. Now that's all the news that we have for today. Tomorrow is Veterans Day. Markets are closed. Financial institutions are closed. I want to say a big thank you to all of our veterans and their families. Thank you so much for your service and your continued service. Thank you for all that you do. And remember, everybody, stay positive. Have a great holiday weekend, and we'll see you on Monday.